Okay, hit it.
It's March 6, 2020, episode 70. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome Jason Goepfert of sentimenttrader.com, where we discuss the overbought setup going into mid-February and the quick move down to oversold levels from the coronavirus scare. Then, what has become my favorite segment, Talking Charts with Patrick, we have a special guest appearance from our buddy Rob Koyfman.
And this week in trading history, we reflect on the market lows of 2009, and Rick Santelli gives us a WTF clip that needs no editing. And then we'll, of course, discuss the top 3 things to watch next week.
It's our pleasure to welcome to the show Jason Goepfert from Sentiment Trader. Jason, thanks for coming.
Thanks for having me.
Well, interesting market. There's a lot happening. It's going to be great. We're looking forward to your chart book that you've included. But before we get to that, let's get to know you a little bit more. How did you get into the business? Why don't you walk us through how you became sentimenttrader.com?
Well, grew up poor in rural Wisconsin, and finance was the furthest thing from anything any of us knew. We never really talked about it. Nobody really knew anything. I mean, it was just kind of hand to mouth type thing. So very rural upbringing. I mean, I spent the first 20 years of my life basically scraping cow dung off of walls because we would whitewash the inside of barns. So when a farmer wants to sell their milk, the inside of the barn has to be clean. And so we would basically paint and insecticide the inside. So you have to clean the barn before you can paint it on the inside. So that was my job, was scraping off the cow dung and the stalls and everything else. So very unpleasant, very dirty, but it teaches you.
Well, you know what? One second, I'm sorry to interrupt. I'd say some people on Wall Street would say it's not much different.
I'm still doing the same thing 20 some years later, scraping cow dung. So I mean that's really, it teaches you a lot of lessons when you have an upbringing like that. So I mean I looked around a lot at my extended family and just everybody else around and realized that wasn't the life I wanted to live. So did what I had to do to get into college. So went to the University of Minnesota, worked my ass off, 30 hours a week in addition to taking classes, and I was on the crew team and some other things. So very busy but good, and I did the typical finance route, finance, economics, accounting, etc. You kind of have a little bit of the God complex at that point because you think you know how things work, and you know all the theory and you know the math and et cetera, and it doesn't take long once you leave to realize that most of it's bullshit. So it wasn't long after leaving college that I realized that is not how the world works. At first, I went to this small bike manufacturer. Have you ever rollerbladed?
Yep.
Okay. Well, the founder of rollerblades, actually, he created a new product called the row bike, where it's a bicycle, but you row it like a rowing machine. And so he'd selected our company to design and manufacture that row bike. So they hired me out of college as their controller, which was a bad mistake on their part because I was not controller material. I knew enough of the accounting to kind of BS my way through, but thankfully the company, they had a falling out with Scott, the inventor of rollerblades. He took the manufacturing to China, and so our company went bankrupt in like 6 months. So that was my first kind of introduction to the real business world and how things worked. It was not about really the numbers. It was about this personal relationship that, this kid who invented rollerblades, and he was a snotty rich kid. I mean, he invented those skates when he was, I don't know, I think he's in his 20s, and he got all this money. And then he just had this attitude that he could do whatever he wanted and he could just tell people what to do. And the guy that had founded the company that I worked for did not take that very well. He was an engineer by training. And so it was just this personality clash. And that's what caused the downfall of their business. It was just this completely irrational, well, he pissed me off, so I'm going to screw him over. And it led to the demise of the company. So that was just kind of the first real hard lesson that, the textbooks can tell you one thing, but when you actually get into the business world, it's kind of a different world. So that was kind of my first introduction. And then I knew I wanted to be somewhere more on the finance side, the brokerage side. This was early mid 90s. So being a trader was kind of the cool thing, that's what everybody wanted to do. And so I went to a temp agency and I just said, get me into a brokerage firm. I don't care what it is. It could be in the mailroom. And they came back later that day, and it actually literally was in the mailroom at Wells Fargo. So Wells Fargo at the time, well, they still do. They have a discount brokerage arm called Wells Trade. And they said, it's literally in the mailroom. You'll be sorting mail, putting like retirement packages together for people that request information. Very bottom rung. I think the offer was like $16,000 a year, and I was thrilled. I mean, I had my foot in the door, and so that's where I started, and I thought it was interesting.
You actually literally started in the mailroom.
It is. It was literally in the mailroom. Yeah. And my coworker, there's 2 strip clubs in Minneapolis. Well, I think now it's down to 1. And my coworker was a stripper at one of the strip clubs. So it was her part-time job. So it was a really interesting introduction to the business.
Again, much like Wall Street today. So from there you end up at a hedge fund, right? Before going off on your own?
Yeah, so this was Wall Street was great. I mean, when I started, I think there were 7 or 8 people, maybe 6, and by the time I left later in the 1990s, there were over 300. So, I mean, I learned every aspect of that business, and so just kept working there, and got onto, well, they called it the trading desk, but that's when a customer would call in to place an order. We would place the order for the customer. So I mean, technically it was trades, but it was just basically customer service. But
Right.
It was customer facing. You were placing trades for the customers, and this was the time. So they had just rolled out online trading, and the online should be in quotes, because you could go onto the Wells Trade website, place an order, and then that would actually show up on this legacy system we had. Somebody would have to notice that it's there, and they would print it out on a dot matrix printer. Then somebody would have to notice that this order was printed out on the printer, go up, pick it off the printer, and then go back to their station and actually enter the trade. So, I mean, it could be 45 minutes to an hour between when somebody entered an order online and when it was actually entered into the system.
Wow.
So, yeah, I mean, it's so different now compared to the way it was then. And even then, people were thrilled. They were like, oh my God, this is great. I don't have to talk to anybody. I don't have to call and be on hold for half an hour. I could just place it online. But I mean, it was such a manual process.
Right.
But that was really my first introduction to kind of this how people were feeling about markets when they were calling in. And it was great. I mean, you can't get any better experience than that. So after that, then I went on to manage the margin and options department for Wells Trade, and by this time it was getting fairly large. So we had pretty good order flow and et cetera. And if you ever want to really hear raw emotions when it comes to retail traders, is hop on a margin call. And so that was one of my responsibilities is I would listen into a call when one of our staff would make a margin call, and man, talk about emotion. It ran the gamut from crying to swearing to I mean everything, angry or whatever, or relieved, and
Right.
I mean it was every emotion you could imagine, and so that was really it made me think there's a lot more to this than all these theories I learned in college about how markets work, how business works, et cetera. That a lot of it's based on emotion and not logic. And so I just, just in my responsibilities, I had to put together different metrics for our margin balances, how many applications for options trading we were getting. And so I had just put together some of these reports, and a few times I had noticed that when we had this surge of either margin calls or option trading requests, et cetera, that it coincided with market turning points. And that just made me think, maybe there's kind of something to this. And that's what really got me interested more on the sentiment side, as opposed to basically any other aspect of it. It seemed like at some points that could really be a driver for how stocks reacted going forward. So put together some of that stuff and basically started Sentiment Trader at that point, putting together this kind of internal report for trading buddies, et cetera, and highlighting extremes. And then got tired of it. I mean, it was the same thing over and over again. I didn't feel like I was learning anything. So I jumped to a relatively large hedge fund here in Minnesota, more on the operations side. Again, still had dreams of being a trader, but those were quickly dashed when I had a quote unquote interview on the trading side. That was an interesting realization that I did not have what it take to be, especially an options trader. So stayed on the management side, but still had this nagging thing that I wasn't seeing or wasn't monitoring the sentiment indicators that I thought really were effective when I was at Wells Trade. And so I was looking just publicly what was available. And there were some things like Schaefer's research was out there at the time. I mean, they were really, as far as I can remember, really the only one that was focused on sentiment. Not much of it was publicly facing. So I just put together some of these indicators from public sources. And I mean, I spent $19 with Yahoo. At that point, you could set up a website, register a domain name with Yahoo for $19 for a year. So I did that. I just threw up this ugly ass website. I mean, it was terrible. It was atrocious. But just threw it up there and put some indicators up there and just some commentary. And then one day, just out of the blue, somebody had subscribed. I think you could subscribe for it's $4 a month or something like that. And that was just, when you get that email and it's like, oh my God, somebody actually paid for this. And so that was really the start. I was like, well, okay, I'm still working, et cetera, but this is somebody out there is willing to pay for this. And so I just kind of kept building it and just kind of took off from there. And then his name is Gary Smith. He used to write for Real Money, Jim Cramer's website.
I remember him. Yeah, I remember him for sure.
He was very, very popular. And then I'd made this call, and then he had mentioned it on Real Money, and overnight we got 300 subscribers, and I was not prepared for that. I mean, everything was manual at that point, so all of our subscribers were in a spreadsheet. Like the payment information was printed out and stored in the safe. It was all manual, and so we got this influx of 300, and it took me, I think, 3 days without sleep to work through them all and get them set up. And I mean, it was it was not a fun time, but at least it made me think, well, there's a potentially not just there's a business behind it potentially. So
right.
I mean, from there,
so what year was that? What year was that it was born?
That was in 2001.
2001. So the website was born in 2001, and you've been doing this ever since, right? Just 100%.
Yep.
You quit your job at the hedge fund, and now you just run sentimenttrader.com. I have a question. Do you I know sometimes you can go on the archives and you can find old versions of web pages. Do you have one of yours?
Oh, it's painful. Yeah, you can go to.
Do you have it?
It's the Wayback Machine.
Oh, okay. You can do that.
Yeah. Let me see. I don't know what the earliest date is. I know I went and it was like 10 years ago, and it's still painful.
Oh, that's funny. Okay, so listen, why don't we get and start talking about you've been kind enough to send us a great package, and why don't we get to some of these indicators that you focus on and get your views of what you think has happened in the past few months and what's happening currently.
Well, it's interesting. I mean, the past week has changed a lot of things. So it's March 6th today. So leading into this in January and February, we'd seen really remarkable optimism to the point where, since we started tracking some of these things in 1998, 99, 2000, we'd never really seen some of these readings before. So it was really a pretty incredible lead up to this. But, those had started triggering really in November. And the market wasn't reacting, it's not something we typically see. It happened somewhat in 2017, where a lot of our indicators were triggering extreme optimism early in 2017, but they were failing to lead to any kind of correction. And we pay a lot of attention to failures. What we do is not perfect. And when it's not working, that often tells us a lot about the market and potentially other forces that are overwhelming any of these extremes. So that's something that was putting us on our heels, was that yes, a lot of these extremes are triggering November, December. Stocks are still creeping higher. Often that tells a lot about the longer term, that there's some force behind it, where longer term, it's a good sign. The medium term of several months, typically there can still be some rocky, some pretty severe drawdowns, even within a longer term positive trend. So that first chart is basically just the number of indicators that we track that were showing optimism minus pessimism, and it had actually gone past that extreme shown on the chart and went into record territory. So, the setup at that point in late 2019 and early in this year was basically almost unprecedented optimism from an objective point of view.
Right.
And it was a lot of these indicators can kind of be redundant. They just look at the same thing. But that second chart, you can see it was kind of spread between. It wasn't just like individual traders that were optimistic. It wasn't just maybe hedge funds. So that second chart is Wall Street analysts, the number of their technical upgrades minus fundamental upgrades, and this is just whether they raise the price target or whether they raise earnings estimates. And so this was as of early in 2020, so January. They were scrambling to raise price targets on stocks that were following within the S&P 500, but they were not raising their earnings estimates. So, when Wall Street, when the analysts see that their job security is in question because their price targets aren't high enough, typically that's a pretty good red flag, and ended up being so again. And just when you look at a lot of the stocks, how they were moving, it was not anything like 1999. I mean, I lived through 1999. I was dealing with customers back then. It was not the same kind of frenzy. I mean, I remember, Qualcomm and some of these other stocks jumping $100 at the open. We were not seeing that. But even just to see Tesla or any of these S&P 500 or NASDAQ 100 stocks that are rising 50% in a week, that's pretty unusual. And it has a decent history of preceding some kind of a blow off, especially when you kind of filter out the ones that are due to like a merger or some kind of a lot of biotechs will see that because they come up with some announcement. This was not related to that. This was basically just pure frenzy.
Right.
Another indication was Fidelity tracks the number of their 401k millionaires, all-time record high. And it's really, to me, it's the rate of change that's interesting. I mean, when you're coming out of the great financial crisis, you would expect the year-over-year change in these accounts to jump because they're coming from such a low level. But when it's occurring when they're basically already at an all-time high, that's something else. So it's just a lot of these things were just like, you know what? There's something going on here that we haven't seen over the past 10 years. Another one is the next chart, just E-Trade, also Fidelity, Schwab. A lot of these discount brokerages, we're seeing their daily revenue trades explode. And part of that, of course, is free commissions. But the other part is it's a bull market. And so, stocks are going down. People, even if trading is free, people necessarily might not want to trade.
Yeah, they buy and hold more. Like they don't want to sell their losers, right?
Right. And so, the past couple of months of the year, the trading was exploding. And again, part of that's free trading, but it just makes you think this probably is not going to end well when there's such huge retail interest. And what really started to trigger warning signs in early February and mid-February was the options market. And so I know you just had Brent on that tracks Gamma. And I think a lot of this is very related. So the Options Clearing Corporation, they release publicly every week a pretty detailed breakdown of the options trading during the week, including how many options are bought to open, sold to open for puts, calls, and also different tiers of traders, like small trades, 10 contracts or less, or different tiers like that. So you can kind of slice and dice this data in pretty good ways and get a sense for how traders are positioned. And over the 6 weeks leading into mid-February, we'd never seen the kind of speculation in the options market that we were then.
Stunning.
It was absolutely stunning.
Yeah, and it was. I think it culminated with Luke Kawa kind of brought this up. The Bloomberg reporter, he highlighted the Wall Street Bets Reddit group, where these guys were getting around and they were doing bull raids on stocks. They were picking stocks and they were all going out and trying to buy like weekly options out of the money and trying to get all the dealers short Gamma and seeing if they could push it higher.
Yeah, but I at the same time, if I can also I think what's happening as well is that there were a lot of people that were skeptical about the sustainability of the rally, so they were renting the upside of the market with calls so that it had limited risk.
That's what, that's the option trader that Patrick has got a program for you if you want to learn how to do that.
There you go.
Okay.
So,
but it to kind of one of the challenges with a lot of these indicators is we don't really know who's doing this trading. We don't really know what their underlying strategy is. All we can do is monitor what the data is saying, what the historical precedents are, and kind of go from there. And those precedents were clear as that when we assume that this is speculative trading. I mean, it could have been bigger traders hedging. It could have been that kind of behavior. But just their history is that when this indicator spikes like this, it has not been good, and it's been good almost immediately. It has almost immediately has led to a pretty stiff decline, is what I'm trying to say. So
Right.
that was really the setup, and then these Hindenburg Omens. I know people roll their eyes, especially if they've never heard of it before. It's basically a silly name for technical conditions where there's a split underlying the market, where stocks are rising, indexes are above their moving averages, but there's an underlying split in the breadth underlying the market. So there's a lot of stocks at 52-week highs, but also a lot at 52-week lows. Breadth momentum is waning. So it's a silly name to a technical phenomena that, it's been around for decades, been highlighted for decades. And those were really starting to trigger in earnest in February, where we're seeing it spread out, not just on the NYSE and NASDAQ, but also within individual indexes. S&P, NASDAQ, Dow, Russell 2000, they were all triggering these warnings. So that was the setup. And typically, people assume this is a crash kind of a signal. And they say, well, the market didn't crash, so it failed. Well, it's not really a crash indicator. It's just it highlights times where risk appears to be higher than reward. And so that was the setup. And it's easy to go back in hindsight and pick these indicators and say, well, the market dropped and so they worked. But I think a lot of these are longer term than that. And so even if we do bounce based on some of the extremes we're seeing right now in early March, longer term, there's still some trouble. I mean, when you look at the frenzied trading activity, like in some of these E-Trade and some of these other brokerage firms, that doesn't go away because there was a week of declines, even though it was severe. So I think longer term, there's still a lot of issues with just the extreme optimism, complacency that had built up leading into February, and that doesn't go away with just a week of declines. But I mean, what a week it's been.
Right. Well, actually, almost 2 weeks now, right? Like it's getting, it's going on. It seems nuts. I actually love this next chart that you have because I was highlighting the fact that VIX, even though it seems elevated, it's actually cheap versus the recent moves that we've been seeing. Why don't you walk us through what we're experiencing here?
Yeah, so I mean, the past 7 days or so have been it's even since that chart was published, it's been a couple more days since then, so it's gotten even more extreme. But it's just the intraday moves that we're seeing in the S&P futures. It's basically crash scenarios that we've seen. We saw it in '87 at the end of the 2002 declines, the financial crisis, of course, and then again that sovereign debt panic in 2011. So I mean, that's the level of volatility that we've been seeing. And it's starting to be reflected now in sentiment. I mean, stocks can move, and people are like, well, it'll go away. But we're really starting to see some panic in some of the indicators that we follow. So that go ahead.
Yeah, no, I was just going to say that I was actually calculating this with my members, and for the last 8 days, the average high-low range of the S&P 500 has been close to 150 S&P points. It's just stunning.
It's nuts.
Including like an average change in a couple of hours of 40, 50 S&P points.
Well, what was funny? I was trading one morning and I was looking at it, and the S&P seemed to be in a range. So I looked and it seemed to it had gotten nice and quiet, it looked like on my chart, right? And then I looked and realized that range that looked so quiet was 30 handles. Which used to be a great day, and now all of a sudden it's the quiet range, right? Yeah. It's gone absolutely bonkers, in terms of the volatility. It's stunning, really. Sorry, go ahead, Jason.
Sorry. Well, this is what we often see. So we had that creeper, I call them a creeper trend, is where the price seems to rise every day. You go up 5, 6 S&P points, something like that. We saw that throughout the fall, early into this year. We have these slow creeper trends, and then all of a sudden everybody panics, and then we have these sudden drops that wipes out months worth of gains. So it's not exactly atypical. It's just the fact that this drop has been kind of off the scale in terms of it's not your garden variety. Okay, everybody panic and get out. It's something quite a bit more severe than that. So, so we're starting to see some of that options data that we looked at earlier. That's starting to switch now. I mean, this is weekly data, so this week will be very interesting to see. But even as of last week, you can see the spike in put. These are put options to open. So you can
and it's a record high, right? Like up until now, 13 million contracts was the absolute high, and we just ticked at 23 million last week, and I'm probably going to even be higher this week.
And this is
it's all my members.
Well, I'm going to preface this by saying that this is relatively misleading, because if you also look at the number of call options to open, that also spiked. So when you net them out,
Okay.
it's not quite the extreme of pessimism that it looks at, but you can just kind of see how the sudden shift in mentality, where all of a sudden people were relatively complacent or very complacent, and now suddenly they're not. So that's starting to, a lot of the sentiment stuff that we follow, it takes time. A week's decline, no matter how severe, it's just not going to be reflected in a lot of the indicators and models. But some of them, the CNN Fear and Greed model is very popular. It's a very good model. We kind of did a proxy model for that, same inputs. We use one slightly different junk bond measure so we could get more history. So we can go back to 1998. And as of earlier this week, it hit 0%. So basically maximum pessimism. And so, shorter term, when you see a lot of these extremes, it's unpredictable. There's so often just violent extremes in both directions. Often we can see these before bear markets. A lot of the things that we're seeing now triggered in 2007.
Yeah.
But in the medium term, which we call 1 to 3 months, almost always, there you can see even lower today for the Fear and Greed Index. Almost always when we see this kind of sentiment extreme, there's a medium term 1 to 3 month rally, even within bear markets. So that's kind of the context that we're in. So the next table.
1 second before we go on, I'll for those that are listening, the median returns 1 week later is 3.1%, 3.3% for 2 weeks. 1 month later, it's 4.7%, and the win rate is through the roof. It's like 89% for 1 week, 78% for 2 weeks, and 89% per month later.
100% for 2 months,
and 100% for 2 months, and 6.76% return. So it is definitely a sign that you should be looking to write some blue tickets if you're gonna kind of 1 to 2 month time horizon.
Well, and that includes data points in the after the bubble burst in 2000 and during the financial crisis. So even within bear markets, when you get to this kind of extreme, typically there's some kind of a reflex rebound over a multi-month time frame. So it'll be interesting to see. Like the next table shows, when we fall into a 10% correction, but it's coming from soon after an all-time high, it almost never morphs into a bear market. Typically, there's at least a reflex rally over the medium term. Again, just another suggestion that that's more likely than not. The next one as well, when there's a spike in 52-week lows on the NYSE, again, basically the same kind of conclusion, that there tends to be a multi-month snapback after you see wholesale selling pressure like that. And then you've got, just some of the goofy stuff. We're seeing price gouging. We're seeing a lot of this anecdotal evidence that people are panicking. The virus fears are leading off local news. Just a lot of these signs where people were too complacent, it looked like, in February, where you had the second largest economy in the world shut down and stocks were rising every day. And you just sit there and think, this does not make sense. Well, now all of a sudden people have gone to the opposite extreme, and they think this is Armageddon. So, the media outlets have to get their eyeballs, and so they take advantage of this. And so, the CNBC Markets Turmoil special, now I think it's been 9 times in the past 8 days or something or trading days that they've run one of these specials. And I mean, it's
Jason,
totally anecdotal.
I love that, though. You started this chart. I think you were the first to do this, and I see it all over Twitter. And it's one of my favorite kind of tweets out there is the number of CNBC Market Turmoil specials. And when you go through and look in history, poor CNBC, they probably got to be ashamed when they see that, because it's often or almost always marked the bottom.
Yeah, they weren't happy. I mean, I think the first time I did it was in 2015 or 2016. One of those was the first tweet, and I got some emails from producers saying, they said it's inaccurate and it's not a good depiction, and they're trying to do a public service. And I was like, well, I said in that first tweet, it might be incomplete. So please send me the dates where you ran one of these specials. And of course, radio silence. They did not respond. So even if it is incomplete, I think it was a pretty good. I think it got most of them on there anyway. So
that's hilarious. I had no idea they called you. So are you allowed? Do they get you on the show or no? You've never been on CNBC since you are tweeting this.
They've asked, yeah, and I I won't. I can't watch the channel. I won't. So plus, I don't think I'd be a good. I just don't want to do TV. So anyway, but yeah, I think
that's how Patrick and I feel too. We got a face. We got a face for team radio. Okay.
Yeah.
But yeah, it's just it's one of those kind of goofy anecdotal things. But there's 5 years of real time history, and it's worked pretty dang good still.
Yeah.
So, and then just within sectors, energy has just gotten slammed. It's getting slammed again today. And when we see readings like this, almost always it's been the final puke phase of a decline, at least over the medium term. So, I mean, energy, there's umpteen extremes you can point at. But when you look at basically the internal severity of the decline, the number of energy stocks that are just getting completely pounded, every single time it's been during the panic phase of the decline. And again, short-term volatility, we're seeing that yet again. But it would be basically unprecedented if we didn't see a medium-term rebound after readings like this. Same thing goes for financials. Kind of a shorter-term reflection of panicky breadth extremes, like the number of financials that are below their lower Bollinger Bands, that are oversold, have an RSI below 30, that kind of thing. When you aggregate a bunch of those together, it's basically the third most extreme since 1990. Both serve to be at least medium-term bottoms or close to it. And again, short-term volatility both ways. But when you see this kind of panic on this kind of time frame, I mean, really the only time there wasn't a medium-term rally, and this even was iffy, it was October 2008, where it was a little bit early. So, if you're selling here, you're basically making the bet that we're seeing more than a once-in-a-generation collapse. Basically, if you think stocks are going to keep going over the next 2 to 3 months, selling like we've seen lately. So, that's just that's a pretty bold bet to make, I think.
Well, or you're a virus truther and you think the world's ending.
Right. Well, I mean, that's what we're seeing is to see these kinds of extremes and then to see stocks continuing to decline. It would be an Armageddon kind of scenario like 2008. And, Tony Dwyer likes to say that, at some point the sun's going to explode, but that doesn't mean it's a good trade. And I'm feeling the same here is that.
Well, but half a FinTwit makes their living betting on the sun exploding, though, right?
It's almost unbearable. I mean, I scroll through and it's like I can't do it anymore. Especially the notifications. When you post something and just look at the comments, it's like, oh my God, I can't believe there's real people typing these comments. Well,
sometimes you get the you definitely if you get a certain crowd, it gets a little tough to take. But I just try to joke about it and have some fun because there's definitely some people who feel very strongly. And if you would suggest that maybe we're going to bottom here and that the world's not going to end, there's a lot of people who are convinced that it's headed a lot lower. And not only that, they feel like it should head a lot lower. And this is my problem. I find is a lot of people mistake what I think in terms of what's most probable as opposed to what I think should happen. And I'm like, what I think should happen is irrelevant. It's what in terms of like the moral judgment of it, I just talk about what I think will happen. Anyways, let's continue here on your charts.
No, I think that was the last one.
Oh, that's it. Okay.
Yeah. So they're kind of pointing to the same direction where short term, I have no idea. I mean, anybody trying to trade short term, unless you're hyper short term and can take advantage of some of these extremes intraday, that can be profitable. But on a day-to-day basis, I don't know how people handle it because just the latest headline, it's going to swing 3% one way or the other. So short term, I have no idea. We could continue to swing for a while, but the kinds of readings we're seeing now on a multi-month time frame, I would say 2 months, kind of the sweet spot. It would just be highly unusual to not see a reflex rally. And then after that, even, I don't know. A lot of the readings that we saw leading up to this decline are really troubling. And, a week or two of declines aren't going to wipe those out. So longer term, absolutely, it could morph into a bear market. We could be in the midst of one right now. I wouldn't make a strong argument against that. But it's just that medium-term time frame where, if you're pressing the downside, you're making a really bold bet.
So, Jason, what I was doing, I overlaid on a couple of charts the kind of an analog of how the last two bear markets started, just to kind of get a gauge as to what happened. In each scenario, there was one more leg lower on the short term, which could still very much be in play right now. And then there was these like 2 or 3 month bounces. Like let's say after that January, February low of 2008, we rallied all the way till May.
Right.
Before the market rolled over. And so it's very likely, if it follows a similar scenario like that, is that like the next couple of weeks can still potentially be lower, but at some point, some multi-month retracement of all of this is like your charts are showing, it's just would be common sense. Right?
Yeah, it happened. It happened a couple times in 2008, late 2007, early 2008, and a lot of the precedents that we're seeing in some of the studies that we do keep pointing to that time frame as a similarity. I mean, certainly it's not the only one, but it's one that's been popping up quite a bit. So, yeah, I mean, ultimately it could morph into a much more serious decline. Longer term, I have some grave concerns, but again, focus more on that medium term. It's I would be shocked if we just continued lower without some kind of a reflex rally from these kinds of readings.
So, Jason, it's Kevin here. You've been doing this a long time, and there's no doubt that the markets have changed. I was wondering how you've noticed how they've changed since this kind of 2 decades that you've been doing the sentiment trader.
Well, some indicators have just gone away. I mean, one of the ones I used to really like was odd lot purchases and short sales. There's really no such thing anymore. So sometimes, markets change and indicators will go away. They're just not valid anymore. So there's, market structure is always changing. Decimalization had changed some things. We're seeing much more volatile breadth readings now because it's easier for a stock to go up or down 1 penny as opposed to an eighth or a 32nd. So some of these structural changes has changed some of the readings. So you have to, when you're looking at data over the past 10, 20 years versus from the 1970s, you have to kind of make some adjustments because things are more volatile now. High frequency trading has changed some of the things. I think price patterns are much less reliable now. I'm sure some technicians would argue with that, but some of the reliable patterns that I used to rely on, if a stock gapped up and then closed below the open, that was a sign of exhaustion. It doesn't work really anymore. So maybe some of the things with this passive investing, I don't know if it's a bubble, but the flow of money into passive investing, the way those ETF companies have to make adjustments towards the close, I think that's just impacting a lot of the price structure that used to be in play. And so a lot of those I think are a lot less reliable than they were in the past. And people will say,
sorry, go ahead. Keep going.
Well, people will say, well, it's only machines trading right now, so how can you measure sentiment? A machine has no sentiment; they have no emotion, and I think that's relatively absurd because, number one, they don't dominate the market; they dominate some of the volume figures, but it's still people pulling the trigger. For the most part, a lot of what we're looking at is it's specifically people that are placing these trades or saying how they feel. So I still think sentiment. Is a valid way to look at the market, but I try to be as objective as possible. And if these readings continue to fail time and time again, I'll have no choice but to say, well, something has changed and they're not working.
Right.
But so far, thankfully, knock on wood, that really hasn't happened.
Right. So I agree with you on the machines because at the end of the day, although there are machines that are doing ARB and stuff, like a lot of those things go home flat or those are, spread trades. But, the big money that goes and moves markets, those are people deciding to put money to work in the S&P. Now, one of the things that I was wondering, though, is you talk about the overbought nature of the market going into February. Mm-hmm. And I was wondering if that... in the old days, if that would have happened faster, meaning that people would have put money to work quicker, and we would have gotten kind of, instead of this stair step, like one step up, one step up, one step up, one step up, it would have spiked more like a 1999 style thing. And I was just wondering if you've experienced any of that, and you wonder about the kind of VWAP large institutions that, maybe the Bridgewaters or the Japan Postal Funds that are just buying, and they're buying for 10 days and it looks like it's relentless buying and it feels like it's a lot of sentiment, but really it's just kind of some large funds putting money to work in kind of a more controlled environment.
Mm-hmm. Well, that kind of happened in 2013 where when I look back at some of the comments where I was kind of first mentioning a creeper uptrend, and so the market was ignoring a lot of the overbought or over optimistic extremes, and so you were saying, well, there's something underlying here it's just shrugging off these readings, and so that was kind of the first one, and then happened again in 2017, and then it started to happen again this past November, and I was pretty confident in November that it wouldn't happen again because it had just happened a couple years prior. That kind of market does not happen maybe once a decade. And so at that point, you got to think, well, there's something here. There's something going on because markets typically don't see this kind of pattern in such a cluster. So I don't know. I mean, it's a valid point because when we saw that kind of market again, November, December, January, it's just I'm sitting there almost every day going, what is going on? we just saw this 2-3 years ago. This is not something we saw this often in decades past. So there's something in whether it's the passive funds or something like that, but it does seem like there was something underlying where it was just something has changed here because this is not natural.
Okay, so I want to put you on the spot. I'm going to give you a little Sophie's choice here. I'm sure you love all your indicators. If you had to only pick one, which would you pick?
We do something called the robo put call ratio, and it stands for retail only buy to open. So it only looks at the smallest of options traders, those for 10 contracts or less. And again, that could be a large trader that breaks up their order into 7 or 8 lots, something like that. But it specifically looks at those small traders, and it only looks at options that are about to open. So that relieves a couple of the challenges from the common put call ratio, where with the put call ratio, you don't know if the transactions are opening or closing. You don't know really who's doing it. So that robo ratio is just more of a pure look at sentiment because you kind of have a pretty good idea of who's doing what. And extremes in that indicator have done really well, even over the past few years of indicating extremes. So if I had to pick one, it's only a weekly indicator, so it's not that sensitive. But if I had to pick one, that's the one I'd go home with.
So Jason, my question is Patrick. What I wanted to ask you was, okay, so now you take this top-down view of what is the sentiment and where everything is. When you actually put this data to work, let's say when you as a trader are trying to put money to work based upon all of this, what do you tend to trade? Do you stick with like ETFs or do you go to individual stock names? And what time frame do you tend to hold these things? Are you in these things for a couple weeks, a couple months? Like how do you convert what you're doing into actionable stuff?
Sure. No, I stick to the basics. So spiders, TLT, GLD, and then the main sector funds. So I bought some energy last week on Friday. So XLE. So I tend to stick to the most liquid basic ones because that's typically what we cover on the site. And so, I don't want to buy like emerging markets when I'm talking about the spiders or something. It's just there's kind of a disconnect there. So I keep it to the bare basics, and those are the ones I tend to trade. I haven't traded an individual stock for probably 10 years at least. It's just I find the correlations are so high that if I get the broader market right, the stocks will take care of themselves. So I don't want to take that stock specific risk, and that's just my personal preference. And my time frame is several months. That tends to be the sweet spot for most of the indicators and studies that we do. So I used to day trade S&P futures. I used to scalp pips in foreign exchange. I never want to go back to that again. So
I'm in the same boat.
Yeah, the thing that lets me sleep is having a multi-month time frame. Anything longer than that, I mean, things change so much, especially when it comes to sentiment, that I just don't feel comfortable holding very long term. If we do happen to rally over the next couple of months, maybe in June I'm going to be extremely bearish, and at that point I don't want to be holding long term. So.
Right. So, Jason, I think back to you whitewashing the cow dung off the walls, and that young guy who wanted to go and make his mark on Wall Street. What advice would you give him today if you were to meet that young fellow?
Do something in the real world. School was fine. A degree does not help me right now. Nothing I learned in college is applicable to what I'm doing now. So I wish I wouldn't have wasted those 4 years. There were friendships, I guess. I don't think I really learned anything. I mean, this push for 4-year college is just, I think, is asinine. So I think probably most people shouldn't go to college, and that's probably not very popular. But there's a lot of things in the real world that college is not going to help with. And so I guess I'm glad I went. Mostly it was a waste of 4 years. So I wish I would have just gone and done something in the real world, gone to work, again, in the mailroom, just done something on the ground floor, learned something for how the world really works instead of just trying to read a textbook. Books are great. I read a lot of books,
Words of wisdom.
mostly fiction now at this point. But yeah, a lot of these market books and theories and these designations, man, when you get into how markets really work, a lot of it just does not apply.
You're right. There's nothing like the school of life. Anyways, Jason,
Absolutely.
for those who want to learn more about your service, why don't you kind of point people in the right direction?
Just Sentiment Trader. There's only one T in the middle. Probably the best option there is Twitter. You can kind of get a sense for the types of analysis that we do, the charts that we post. We've got a free blog that kind of does a similar thing. And so, yeah, that's the best place to kind of find out what we do.
For those who are interested in sentiment, make sure you check out Jason's work because it's really top notch. And it's been a pleasure having you on. Thanks for joining us.
Thanks, guys.
The sponsor of this week's Market Huddle is Koyfman. Koyfman is a new platform that gives you professional-grade data and tools to analyze stocks and understand macro trends. It's a personal Bloomberg terminal for those who don't have $25,000 a year to spend on a Bloomberg. The best part, it's completely free. Go to koyfin.com today. That's KOYFIN.com.
Time for the rest of the show. Lena, hop on.
Hello.
Hey, great to have you.
Lena.
Thank you.
Who is our beer sponsor this week?
Beer sponsor this week is yet again Big Spruce Brewing Company's Kitchen Party Pale Ale.
So
Kitchen Party.
I'm very excited about this one, especially since the last one was, what was that again?
Oh, the oatmeal thing?
The oatmeal thing. So, listen, it's got to be better. Lena, why don't you tell us a little bit about this while we're drinking it?
So the Kitchen Party Pale Ale is a dry-hopped, full-bodied pale ale with hints of citrus and pine. Solidly bitter and wonderfully aromatic, this beer pairs well with all foods.
So I'm a buyer. I like it.
It's good.
Yeah, I'm a little confused because it's Big Spruce and then it tastes like pine. I don't understand all these guys that are putting trees in their beer, but I still like it. I'm a buyer.
All right.
Okay.
But
Let's
before
move
we
on.
move on, I wanted to mention something.
Yeah.
Oh, all right.
We got to talk about Patrick's hat trick, is what I call it, because he caught the market top for the third time.
Oh.
Yeah.
Right? That's
you're
something
bringing
to
this on me.
mention.
Did Patrick actually get something right?
For the
Periodically
third time,
happens.
no less.
Periodically.
Yes, Patrick.
happens. Thanks for the shout out, Nina.
Yes, very good of you. Lena,
And you know what? He even predicted Corona beer would suffer in sales, and guess what? They're plummeted in sales right now. So
Guys are guru.
Unbelievable.
It's a guru.
he's on a roll.
He is on a roll.
All right.
Okay, let me do my legal stuff. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include agitated scarring sell-off, dog rash ruination, and chicken eyes chattering chopping syndrome.
I didn't catch all of that, but I thought it was funny.
Okay.
All right.
Okay, now it's time for my favorite segment, Talking Charts. And I usually get to sit back and just listen to Patrick speak, but I have the pleasure of having Rob Koyfman on with us. And he's going to walk us through his Koyfman product. Rob, thanks for joining us today.
Thank you so much for having me. Pleasure to be here.
I was kind of laughing because I think that having you here is much better than me butchering doing what you do on your video so much better than I do.
Yeah, no, I think you did a good job over the past couple of weeks. And
yeah.
Particularly when you said we're better than TradingView. I really like
that. Anyways, I'm going to sit back and relax and let you guys go. But Rob, why don't you take the show away? Why don't you walk us through some of the more kind of used features and the functionality of your product?
Yeah, cool. So let me just go over a couple of the most popular features and to give you a lay of the land. So the reason I started Koyfman, and one of the things that I was really missing when I didn't have my Bloomberg, is to have a platform that had data from all these different asset classes. So I didn't just want stocks or ETFs or futures. I wanted everything in one. And that's kind of one of the advantages that we have is we bring all this data in together. And that makes it interesting, but also challenging to find data. So what you can do is you can use the search bar to give you a sense of all the different data we have here. And so if you search for like mortgage rates, you could go under econ and filter by that, and then we'll have that here. And you'll be able to select that and ultimately then graph it in here with your mortgage rate. The other kind of like Easter egg I'll give you guys that not a lot of people know is that we have a directory that's not very obvious. But if you go to Koyfman.com directory, you can find all the data in here for all these different asset classes. So under the United States, we'll have all the economic data, all the economic indicators with all the tickers and stuff like that. Cool.
Hey, that's nifty. I didn't know that. So Koyfman.com directory. / directory.
That's right.
Yeah.
That's right. So
that's awesome.
So that'll give you a sense of kind of like all the different data that we have on there. So that's kind of like one thing to think about. Second thing, our most popular feature is probably this area called My Dashboards. And this sidebar, basically, we have three areas. One is My Dashboards. Another one is where you browse different categories that we've created for you, different dashboards. And the third one is really where you kind of create your charts and look at particular securities. So this area, My Dashboards, you're definitely going to want to create some dashboards. These are all the dashboards that I created. And you can create a new dashboard right here. I have my table here of SaaS stocks. What's cool is after I put in these stocks, I could customize all these columns. So I have my standard column. I have my valuation column, which will kind of turn into here. And so really, we have about 250 indicators that you could choose from. And you could create your own column in here, your own view in here in terms of different ways to look at securities. You also have this graph here where you could select different ways of looking at each security. So I have my technicals graph here, and I can just go through my securities right here. And then the last thing I want to mention on dashboards is once you create a dashboard, you could share a dashboard with someone else that they could follow. So for example, I follow the coronavirus dashboard, which someone else created. And so that's in my follow dashboards, and then I kind of see all the stocks that one of our users Anne created, and I could track this dashboard pretty easily. So those are the basic things on dashboards. Make sense?
Yeah, no, that's really nifty.
Yeah, cool. And then the last thing is really kind of to mention is really our graphing capabilities, the ability to really create a chart of anything. Again, with a bunch of different indicators that you want. So if I wanted to go to my unsafe template and pull up the mortgage rates here, I could just add US 10-year rates here, and that would pull up in the same chart. And then if I wanted to pull that up in a different chart, I would pull that back and make it on the same chart. So a lot of flexibility on how we chart and graph different things. And once you create a template that you want with, whether it's with securities or with a bunch of different indicators, you could save that as a template. And what a template does is it lets you look at the presets very easily going forward. So maybe mortgage rates is not the best example. So let me just pull up SPY as a better example with some stuff. So this is my price and volume template for SPY. This is my technicals template for SPY. I have a fund flows template here where this is my price, and then I have fund flows for SPY to kind of see how they're doing. So it really gives you the ability to create any sort of technical template, any valuation template, any fundamental template, and again, lots of different technical, fundamental, and valuation series that you can put in there. So that's the 5-minute spiel.
Yeah, that's terrific. Actually, I'm just looking at this, the fund flows. Why don't you walk us through, like, if you wanted to make one of those from scratch? And does the fund flows kind of work for all ETFs? Like, so if I told you XLE, and would we be able to see the fund flows for XLE? Like, could you walk us through how a user might make that chart?
Absolutely. So let's start on the homepage. So this is kind of like my homepage, and to get to that chart, you could either go to this historical graph. But a shortcut to do that is I would just type in XLE, enter, and I have my graph here that I could just hit enter again on, and that'll take me to this area over here. So this is just a shortcut way of getting to this graph. And once you get here, you're going to have some predefined templates that we created for you. But the way to make a new template is you go to Unsave Template, you go to Add New Data Series. You can either browse what you're looking for here for the different stuff. So we have a lot of performance indicators or relative strength or Bolger bands. The quickest way is to probably just type in flows, and I would put in my daily flows. So these are my daily flows that I have. And then I would add another series called flows. And instead of daily, I would just select cumulative. So this gives you a different series. And then one thing that you're going to want to do is just take this cumulative because they're overlapping and just going to want to put it on the new graph. So now I have my price chart, my daily flows, and my my cumulative flows. And let me change my cumulative flows to so that's a little bit better.
Nice.
Cool. And let me.
That's terrific.
And let me actually.
That's so that's unbelievable in terms of the functionality that you have. That it's so quickly and easily done. Like that's actually way easier than that $25,000 a year one that we all use, right?
We're all slaves to, absolutely. So
that's right, the slaves to. And you know what? He's spending all that money on trying to become president.
Not effectively.
There you go.
Sorry, last step here. So now that I have my template, I would save this as my template called like flows market huddle MH, and I would save that here. And so that template now is going to be here for any other stock that I want. So if I'm back on the home page and starting all over again, and I want to look at flows for TLT, I would just go to TLT. I could go to the graph here.
Funny you choose that one.
Yeah, exactly.
That's a good conversation piece.
Yeah. Well, have you guys been looking at bonds for any reason? Yeah, exactly.
Oh, yeah.
No, never. Yeah. I never talk about them nor inflation.
Yeah.
Well, Kevin's had one spectacularly amazing call and one absolutely spectacularly horrible call.
I would say that there's more than one spectacularly horrible call. Well, it's a series of spectacularly horrible calls. It's kind of the stop clock. If you keep calling for a top, eventually you'll be right.
No, but so Rob, he basically called the prairie dog on the Japanese yen and the euro. That was a spectacular call. So I'm going to give you kudos on that. But I can't believe how spectacularly wrong you've been on bonds.
Yeah.
I mean, it's like yields are south of 1%.
Rob, this is a source of great amusement for Patrick.
It is. Watching you perpetually.
Yeah, for sure. I completely agree.
You just can't do it.
Yeah.
It's unbelievable.
Anyways, so listen, not only are you a terrific programmer that does all this great stuff with your product, you're also an kind of macro trader. What do you think of the markets here, Rob? Why don't you why don't you kind of walk us through what you're thinking and do Patrick's job for us and talk charts?
Yeah. So look, I think a couple of things kind of that I think are important to highlight. So number one, in terms of where we are, the sell-off has started, and it's obviously becoming very intense. So kind of the question is, where are we in terms of, are we at the start, in the middle, towards the end? I think a good way to do this stuff is really to take a step back. Let's put this on the weekly chart. Weekly chart. And what I'm going to do is I'm just going to look at the drawdown for S&P. So just like how much it's the drawdown from peak is over time. And let's actually look at it on a since 1930, right? And so if we look at this drawdown chart since 1930, and we're now here at about 12%, you have to take a view on how bad this is going to be. Is this going to be kind of like one of these drawdowns that's between 10 and 15%? And by the way, I do think we're going to make new lows, and this stuff is going to get worse. Or do you believe that this is going to get kind of like the 2000 and 2009 area, which is a much more intense sell-off? My personal view is it's going to be more on the mild side because we just don't have any of the leverage or overvaluation in a particular asset that we had here. So housing here, obviously internet stocks here. So the way I'm looking at the market is that it's going to be sort of a 10 to 15% correction or drawdown, or 10 to 20%.
You know, what's the interesting observation there, Rob, is that, the amount of intensity associated with this Corona headline is so intense. But if you put it into context, the sell-off that occurred in December of 2018, the Christmas massacre, saw close to a 17% drawdown.
No, it was 20.
No. I'm just talking December. You're talking September to
okay.
thing. I'm just talking the last leg.
Okay.
Like that in the month of December, from that little peak, we basically sold off for about 3 weeks of December in a straight line down to the Christmas Eve massacre low. And that was about a 17% sell-off. And this sell-off in the market on the coronavirus was less. It's 16%. I mean, it happened in 5 days, though.
Right.
But the point is that we still actually have not, on a percentage basis, back then in December 2018, there wasn't a coronavirus catalyst. And here we are, a sell-off that hasn't yet actually even surpassed that. It's just an interesting observation. I don't know. It's like, I would have thought that if the coronavirus was more serious, that there's going to be at least more selling than what we saw in 2018, right?
Yeah. So I think that's a great point. And I think my response or the observation is, this sell-off over here was the central bank, was our friend Mr. Powell hadn't acknowledged all the stuff that was going on. He was basically like, look, inflation's high and we're not going to ease. And this is really what forced this hand. I think right now you're at a much different point where the Fed has already eased. And I think all the talk over the past week saying that the Fed shouldn't have eased, I think is crazy. I think if the Fed hadn't eased, we would have kind of been down here by now. But
you think so, eh?
Absolutely. So I think markets were pricing a cut, and if the Fed did not deliver that cut, this is what would have happened in terms of intensity, and I think risk would have just froze up.
Oh, I completely agree. These people that try to tell me that if they hadn't cut, we would have been higher is like such bullshit.
Yeah.
Like the reality is that he signaled Friday, a week Friday, like a week ago, he signaled that they were going to cut. He came out at 2:30 and said he basically, admitted they were going to cut. Right. Now, whether it was going to be, I thought it was going to be Wednesday morning because that was when they had generally done it in the past. He did it on a Tuesday. So he surprised the market by a whole day. But I would argue that was completely and utterly in the market. And that's why we rallied so hard on Friday and then subsequently Monday. Right? And then he cut Tuesday and it sold off, right? Is that, if I got the timing right?
I think you're exactly right. I'm trying to pull up the correct series here. Fed funds here. Hold on a sec. FDTR. That's so even I have some trouble. But let's just pull it up here so we're all on the same page. FDTR.
While you're doing that, I'll just say another thing is that if he had done it a week earlier, it would have been a lot more effective.
I agree. I agree with that.
Yeah. I just it sounds like you're in the same boat as me. That they're late. They're chasing the market in terms of what they're expecting. What's amazing now, Rob, is that the market. You go look. They've got 75 basis points of cut built into Christmas time. We're going to be at 25 beeps according to the Fed Fund futures. So that means if they go ahead and do that's just going to meet expectations.
Right. And what's after that, right? And that's yeah. And so
and this is the whole problem with the Fed is that they never get out ahead. They're always just chasing the market, and so it's not effective because all you're doing is just giving the market what they've already priced in, and if you don't give them enough, it just causes more stress. Anyways, I shouldn't rant. I shouldn't rant.
You just did.
What else do you think? Walk us through some more of your charts. What are you looking at? What are you seeing?
So this is so again, kind of like this perspective, I think is a really interesting one, and gives you a sense of where we are in the decline and where we could be going forward. But I think we're about halfway through a little bit more, and the reason I say that is kind of just based on this framework of drawdowns. I think one thing that you guys have highlighted really well on the show is corporate credit and where we are in corporate credit. So
Right.
I think you looked at the high yield index, the broad high yield index, but if we just do that, and by the way, anytime you have these charts and these dashboards, just hit this little arrow here, and that should open up the chart here. And just to give you a sense of where we are in the credit set. So the bear argument here is that this is going to get much wider, and the bull argument is that, look, we're still pretty tight. Like, nothing crazy is going on here. And I tend to be on the bullish side, meaning that I don't think there's just a lot of leverage or unknown leverage in the system where this is going to blow out, similar to what going to happen here when no one.
So you take it to mean that it's not a function of the market not being smart enough. You think the market realizes what's happening and yet is still hanging in there.
Absolutely. So,
interesting.
So I think there's definitely going to be an economic slowdown in the next several months. That slowdown is going to cause companies to potentially default on some of their debt, particularly in the energy space where commodity prices are collapsing. But I don't think there's anything unknown about that. And so I just, unless with all these things, you sort of have to take a view on the future with probabilities. But unless things get really out of control, I think base case, you have to assume that that spreads actually don't blow out that much.
Right.
That's interesting because that would be kind of a very out of consensus view. I like it. I like it. It's the kind of thing that most people are, it makes a lot better headlines to come and say, oh, these are blowing out. We're going to go all-time wides. Look at all this stuff. It takes a lot gutsier call to actually say, listen, the Fed's going to be there. The liquidity is going to be there. It's not going to be as bad as everyone expects.
Yeah. I think I was not in the market in 98. So I graduated from college in 2002, but 98 is kind of an interesting heuristic or an interesting time to observe for some comparisons, because in 98, what happened was you had obviously the financial crisis, the Asia crisis, and the Fed eased a lot more than people expected. And what that caused is just a lot of just a huge increase in asset prices. And I think that this
coming out the other side, you mean after the crisis, was contained. The other side was the basically run up to the 2000 .com bubble top, right?
That's exactly right. So, and again, I think every episode is different. So I don't think this is like 98 at all. I think the takeaway from 98 is you had something happen in the world, which was economic issues in Asia. The Fed eased a lot more than people were pricing unexpectedly. The global banks eased around the world, and that just caused the second leg of this asset bubble to continue. So I think there's a good chance that 6 to 9 months from now, if the coronavirus could be contained and the Fed has lowered rates to 25 basis points, you might see kind of a similar dynamic.
Yeah, I completely agree. We could be screaming higher. Rob, it's been a pleasure having you on. Why don't you tell people where they can go find your stuff, where they can sign up, and how it all works?
Yep. So just go to Koyfman.com. The entire system is still free. So you just have to create a username and start using it. And then in the future, we're going to have a freemium model where we're going to have a free offering, and then you can pay for more advanced features and more advanced data.
That's great. So it's Koyfin.com. Make sure you check it out. It's a terrific product. And, as a former Bloomberg user, I must say that I look at it and I kind of laugh when I see the G and the GPO and all the functions that I'm used to. It's it kind of makes me laugh, and I really love it, and it's terrific. Thanks a lot for sharing, and thanks for being with us today, Rob.
Awesome. Thanks, Patrick. Thanks, Kevin.
Let's get to this week in trading history, Kev.
Okay, so great. But what do you got for us, Patrick? I'm going to go and drink my beer.
All right. Well, we want to go all the way back to something that actually many people do remember.
Yeah, even the millennials remember.
Even the millennials could remember it, but
that's not true, actually.
Yeah, actually, there's a whole wave of traders that were not there.
Yeah. This is where, of course, talking about the great financial crisis of 2008 and 9 and the low print of March 6, 2009.
Yeah, so it was March 6th of 2009, and the bear market low came in on the S&P 500, printing the low of the number of the beast.
The number of the beast, which
666. on the S&P 500, and that became one of the single best buying opportunities of the decade, right?
Oh, listen, it was outstanding. Think about it. Things run like it stole something since then.
So, but what was interesting when we throw back, and like I just want to reminisce on it a little bit rather than go on to a big story. But what was interesting about it was that there was a lot of things in the markets that were actually kind of giving clues that the market was going to turn. For instance, it was several months earlier that we saw Treasury yields. It was I think in December of 2008, just about 2-3 months before, that they bottomed around 2%, just above 2%, and were already trading north of 3%. By the time March 6th rolled around.
Right.
As well, several weeks before the bottom, we saw the bottom in oil, which was rallying. Treasury bonds, oil, even the dollar ended up peaking and started to sell off. It actually was very much in line with that bottom. But a lot of those risk-on, risk-off kind of trades were already advertising that equities, but equities kept selling.
Right.
And it just kept going. And then they bottomed, and then they just never looked back. It's interesting because you could do the reciprocal of what was happening here, but right prior to the sell-off. Because if you think about it, bonds, oil, everything was already warning that it's in a risk-off environment, and the equities were like, nah, it's everything's cool. We're just going to keep going higher. But yet, and then suddenly equities cared all at once and just started to correct, right?
Right. You know what's funny, Patrick, is you brought this up. You've chosen this as our This Week in Trading History. And I don't know if you follow Occupy a Job on Wall Street.
Well, you've brought him up.
I've talked about his stories. This guy is just, if you don't listen to it, he's both a podcast and you can read his stories. He is some of the funniest, greatest stories that you've ever heard. I don't know how he gets away like with his wife reading these stories and he's not already divorced, but they're just like busted gut laughing at some of them. And he brought this up this week as well. Like he did it. And I'm going to quote him, Occupy a Job on Wall Street. And he talks about the Art Hogan bottom. Do you remember Art Hogan?
No.
Art Hogan is a strategist that often came on to CNBC. And I'll just read from Occupy a Job on Wall Street. He says, and in the midst of it, and he's talking about this sell-off, and in the midst of it, a strategist named Art Hogan from Jefferies gets up on CNBC and starts screaming that this is the bottom of the market. And back then, everyone was glued to CNBC. It was so counterintuitive. 200 years ago, they would have locked this guy in his cellar to live out the rest of his existence. Now, the timing of Art's call might not line up to the day, but I'm not one to let specifics get in the way of a good story. The fact remains that no one wanted to listen to the best financial call in history.
Wow.
And I think you should, if you have your interest, make sure you go, sign up for Occupy a Job on Wall Street or listen to the podcast. I don't miss it. And this is another great one. He actually talks about the fact that when you look at not only is 666 the number of the beast, right. And Lena says people sold their souls on that day. But there's also things that March 6, 2009, so 369.
Really?
Yeah, and there's all these things. Anyways, the numbers for those numerologists in the crowd, we're going to enjoy this Occupy a Job on Wall Street's post. And do you remember that day? Do you remember the specific day? I don't remember the specific day, but I do remember how ugly it was.
Yeah. Who was oh my God, what was the name of that lawyer that was on CNBC that died later, but he made the call?
Mark
yes.
What's his last name?
Oh my God. Haynes?
Mark Haynes, that's right.
Yes.
So he unfortunately passed away, and he was the same way. I think he called the bottom as well. And
he was on record for the bottom.
He also went and called the bottom, and the Mark Haynes bottom was what CNBC and Tribute did for the longest time.
Yeah.
But it was just an ugly time, and I alluded to it on a recent post, Patrick, where I said, whenever you bought something, even though it felt like the right thing to do because things were so cheap, your inventory was immediately red.
Yeah.
And it just shows you that markets can go to stupid levels because it really should have never been 666. That was just a dumb.
But what's
level.
crazy though is it sold down there systematically. It wasn't a capitulation dump. Every day it was down lower and lower, and for 2 days it traded down there. This wasn't like just some little.
No, I agree.
It wasn't like some puke.
But I compare it to the bond market right now. I think that when you looked at that, you kind of knew that, or you suspected a year from now those would be good purchases, but it was so tough to do because your inventory was red the moment you put any like blue tickets into it. And that's what bonds feel like to me today. I think I'm confident a year from now, these are going to look like terrible purchases and they're going to be awful things. But
you had to. I
have to.
You know, like, this is a perfectly great conversation, and you have to bring your biggest losing trade in history.
No, anyways, so if you were a stock market bull, you know, and you were a week early or a month early, you look like a fool. And you look like you just didn't get it. And at 666, all the bears were dancing on you, saying, "Oh, you're so dumb," and stuff like that. Look at where it ended up. And that is where I think I almost think we have the exact reciprocal situation occurring today in bonds.
You know what? We should have asked Jason about it when we had him on earlier, because that
would actually take some planning. Patrick.
That would have taken planning, but it would have been interesting to compare because we saw on those bigger charts such huge extremes on the upside of the market, and I'm wondering whether the house. Well, I mean, it had to have been incredibly oversold back then, but was the divergences like it was the real puke in 2008, and this was just like a divergent bleed out or something? Anyway, it's interesting.
I'll tell you one story before we leave because I was kind of laughing about this with the guys on the desk earlier. Right. I remember Citibank. And I can't remember exactly what day it was, but there was a period where the government guaranteed the debt. And I looked at the kind of announcement and I came to the conclusion that the pref was going to be money good, like not money good, like as in they were going to make it money good 100%, but they were going to make it money good. People were worried it was going to actually go out of business.
Right.
And the pref had been trading at $2 or something like that. And it opened at $4, and I thought it was worth $8. And I bought stupid, irresponsible amounts because I thought it was going to 8. Goes to 3. I go, well, geez, I'm a little wrong. I buy more, which is even more irresponsible. Then it goes back to $2. Okay, so think about this. They've just announced the government's going to make this thing worth $8. Okay, I've read it. I'm pretty sure I'm correct. And the thing falls on my face. I am offside size. And I'm scared. Of course, like I'm an idiot. I bought too soon and stuff like that. And I remember the fellow that worked with me is a younger guy. He watched me. He watched how much I was sweating. I told him why this was happening. I said, I would love to buy more. I can't. Like, you know, my broker's going to sell me out if I buy any more. And the bugger, what does he do? He goes out and buys size at $2.
And he then...
Yeah, by the end of the day, it was $5. But it's just the point of this story is that during these periods, it becomes very irrational. And this wasn't something that traded like 10,000 shares. This was trading gobs. I am talking gobs, Patrick. Like there was huge size, and it was so inefficient. And when I laugh, because when I see these guys tell me Michael or whatever that guy is, random walk down Wall Street, and they try to tell me the market's so efficient, I go, just utter bullshit. You have not traded, because I am telling you, there are moments when the market becomes so mispriced and things get so stupid that you don't understand how inefficient it can be, and it's shocking.
It is.
Yeah.
It is.
Just like bonds today. Okay.
All right.
We'll leave it at that.
Let's leave it at that. So now let's get to the WTF clip of the week. And so you found something and you didn't have to do any work with it.
You know what, Patrick? I was going to do one. I was working on it, and then good old Rick Santelli from CNBC served one up in my lap, and I said, oh my God, this needs no editing. I can't believe you said this, Rick. Anyways, let's roll the tape.
Think about how the world would be if you tried to quarantine everybody because of the generic type flu. Now, I'm not saying this is the generic type flu, but maybe we'd be just better off if we gave it to everybody And then in a month it would be over, because the mortality rate of this probably isn't going to be any different if we did it that way than the long-term picture. But the difference is we're wreaking havoc on global and domestic economy.
Listen, he actually came on today. Did you see it? And he came on and said sorry. Like he did a heartfelt apology. So I shouldn't give him too much. He owned
but he
it.
did say it.
Yeah, he came up. He owned his mistake and he apologized. And let's just put it this way: even if you're thinking that, you just don't say it. You don't say it on TV.
Yeah.
Like, we're drinking beers and I think shit all the time. And I'm like, I better not say that. That's stupid, right? Like, I'm going to get in trouble, right? And like, I know it doesn't stop you, but it usually stops me. And Rick Sandelli said something that, like, I understand his frustration.
Yeah.
He's basically arguing that this virus is out everywhere and that we're stopping commerce, we're stopping everything because we're so scared. And there's no reason to be as scared as we are. I think that's what he wanted to say.
Yeah,
you think?
But I don't think he understands what it is for our healthcare system to be overwhelmed at once. The whole point is to slow the rate of which it's spreading, so that our healthcare systems can actually take the rate of which these people are coming in. And I think that give it to everyone all in 1 month. Come on,
no. Listen,
our healthcare system
it was just boneheaded stupid.
Yeah.
It's something you expect from like your 15-year-old kid.
Yeah.
Like, it's just, and if it's a boy, 19-year-old kid, because they seem to take longer to figure things out. But I was shocked that he said it. He tried to say today that it was kind of like giving everyone the measles when he was a kid, that they used to have measles parties or like chickenpox parties. Did you have those?
No.
Oh, we didn't either, but I've heard of these things where like someone would get chickenpox and everyone would bring their kids together and like let them play so that everyone would get it.
Oh my God.
You've never heard of this?
No.
Oh yeah. It's just like
get it all over with.
Yeah, they're just getting, like, basically that's what he wanted to do. He wanted to have a COVID.
One parent can take care of all the kids.
He wanted to have a COVID-19 party.
Oh my God. All right, and that's enough. We're moving on. All right, let's go. All right, Kev, it's time for the top 3 things to watch next week. But before we do, let's talk about the last week's. And so last week we talked about whether there was going to be that peak price in gold because of that one drop that happened. And boy, did gold spectacularly reverse.
Yeah. Okay, so I got a little inside baseball on this. I'll give you.
All right.
Okay. There was a big buyer of call options that came earlier in that week that bought so many call options that one bank couldn't even sell it to them. They had to split it among 4 banks. That's how big it was. And when those guys were grabbing deltas, they sent it to new highs. Then we got the sell-off. And what happened was, on the way down, gold became a source of funds. And not only that, all the banks were short gamma. And that made it worse. Remember we had the big $50 down day?
Yeah.
Complete gamma puke. Like, it was, listen, that's what it was. And that's just what happens when you make, when someone's got that sort of size. And to me, there's the easiest way to explain it. And it's that simple, right?
Well, you know what? We're back up to those highs. The question is now, will gold break the new highs? That's going to be the interesting. Anyway, number 2, the spiking. That's already a given.
The spike in COVID-19 cases in North America.
Yeah, it's happening.
It's happening. Listen, it's here.
It's here.
Like, it's here.
We don't have to say anything else. It's here.
Well, let's stop talking about it.
Yeah. And so number 1, do we get that Fed intervention?
What did I say? I said Wednesday, right?
No, you said over
Sunday?
the weekend.
I did. I screwed it up. Okay.
No, but
yeah.
You were right. I mean, just off by a couple of days.
Like, I wrote that I thought it was going to be Wednesday, but maybe that was, I can't remember. I say a lot of things. They don't seem to stop me. I mean, if I say enough things,
if you tweet out Monday, but then say Sunday, and then write a blog about Tuesday, then one of them is going to be right, and you could turn around and say, I nailed it.
Yeah. Well, no, I don't say that. Because I get so many things wrong. But
you were right.
I do think that, listen, let's just talk before you leave this one.
Yeah.
I will say that I was disappointed on the intervention from the fiscal side. And I contend this is why the market is having trouble. The Fed did everything it can. Some people are saying they didn't do enough. Bullshit. What the hell do you want from them? They got 50. They did it out of the blue. It wasn't on a scheduled meeting. They did everything they could. It's actually who's falling down is the federal, and they need fiscal. And it's not just the U.S. government. It's everyone. It's Europe. It's Japan. It's everybody. There's no leadership in this thing, and that's why we're falling down.
Yeah.
Okay.
All right. Well, there you go. You heard it. So that was last week. So let's get to this week. So first of all, actually, before we even get to number 3, we had a number 4.
We did. I insisted on number 4.
Right.
Because I don't know if people remember, but when we were talking about the bond market, both Patrick and I thought that the top was in last week.
we
and
butchered
so
it for
when
everybody.
we agree on something, you know that it is going to be wrong. And not only was it wrong, it was so spectacularly wrong that it's not even funny.
Like, look at this move in the TLT from 156 to 166.
Yeah.
$10.
I wrote a piece, and I'm gonna repeat the line in there that I wrote because I think it's funny. One of my competitors at another shop, the main risk taker, we got to know each other very well afterwards, and we would trade our own accounts and laugh about stuff. And one of the lines that we always had was whenever somebody would say, "Oh, you know what? I'm gonna sell this or buy this because this is a 4 Sigma move," and my buddy would look at me and says, "You know what the problem with 4 Sigma moves is, don't you?" And he'd say, 4 Sigma moves never stop at 4 Sigma; they always go to 6 or 7. And I was joking, and I said to myself, because I saw all these things about how the bond market was a 4 Sigma move. I saw all these Bloomberg guys showing how this had never happened before in history. And sure enough, the 4 Sigma moves never stop there. They always become 6, 7, 8 Sigma moves.
That's
words
of wisdom, buddy.
Yeah,
words of wisdom.
It is. There's no such thing as, just like there's no such thing as triple bottoms. There's no such thing as 4 Sigma moves.
You heard it here. That's the wisdom of Kevin Muir.
That's right. And so the real point of this is when Patrick and I agree, you should fade us with all your money and a full margin and lever to the hilt. Because we agree we're so wrong. And you should have known when it was like bonds, like Patrick actually agreed with me on bonds. That's bad news.
Well, look, I actually didn't go short bonds.
No, I
simply took
profits. You know what?
Because
for you, like being like flat is being long is short, and for me, it's like being long flat
short
long is like flat. So I get it. But anyways, just wanted to throw that out there. Everyone can send us, all the ribbing they want. We screwed up.
All right, okay.
So
let's do round 2. Bonds still going higher.
I am not going to Gucci this. I got too much money on the line, so I'm not going to talk about bonds because.
Oh my God! You've just been talking for 5 minutes.
No, no.
Okay, anyways. If you have too much money on the line, then that means you're short.
Who knows? Who knows?
You've never bought a bond in your life, buddy.
I did when my margin clerk made me buy them back. Okay, let's go through the top.
Number 3, the floodgate is it now open on oil? And this is asking whether or not the reverse prairie dog. What do we call the reverse prairie dog? Was it a loon dive, or what do we call it?
The loon dive. I like it.
Right? Like
I like it. But the trouble about the loon dive is that the loon goes down for a long time. Like it doesn't come back up. So I don't know if that's really like appropriate. And actually, we might have just ensured that the oil is going to go down for a long time. Can I tell you a loon story on the side here?
So,
I know we're trying to do some work, but I like this loon story. I'm a big windsurfer, and I go to North Carolina, the Outer Banks, which is this like kind of beach, like this sand dune that's along the coast of North Carolina. I go windsurfing there. And I went one year, and there was this fellow there, and he was kind of an eclectic older guy, and he was character. And while he was out, driving around, he saw a loon that was stuck in a ditch. And you go, stuck in a ditch? Like, what the hell? Why didn't the loon fly away? The loon is one of the few ducks that doesn't have hollow bones. And if you think about a loon, it takes a long time to get up to speed. Right? Like it flaps along the water for a long time. So this dumb loon got himself stuck in a ditch and couldn't get himself out. And he was struggling. He couldn't get himself flying and stuff like that. So this guy, he's a Canadian in North Carolina. He sees this loon stuck in a ditch. What do? Of course, you're going to save the loon. So he goes and he gets the loon and he wraps it in a towel. Okay, and he gets it in the car, and he's all alone. He's got the loon wrapped in a cowl, and he's taking him over to the ocean side so that he can get a runway to get himself going, right?
Okay.
And what do you know? The loon wiggles himself out free and starts attacking him in the car.
The Good Samaritan
he's
suffers.
there, like, kind of like trying to like drive while the loon's attacking him. Oh, okay. Anyways, what was the point? Oh yeah, we're talking about oil.
Yeah, we're talking about oil.
So we had kind of an announcement today that Russia didn't want to play ball on the OPEC announcement on the OPEC deal, right?
Right.
And we've got a new push to new lows. I don't know. It's tempting to get all bearish and say this is the end of the world in oil. I just think, Patrick, like, tell me who isn't bearish oil.
You know what? I actually think there's a lot of people that actually believe these energy stocks are stupid cheap, and there's a lot of people that are bullish. Yes, I do. But with that said, the thing is on the short term, everybody is concerned that we're heading toward a global economic recession because of the slowdown due to the virus. And obviously, that's creating contango in the oil markets, and spot prices are just nosediving. I mean, the farther end of the curve is still actually holding up somewhat. It's really just the front end that's really imploding. The point, though, is that we've broken pretty key lows, and so at this stage, the question would listen. We don't have to make the call. The thing to watch for next week is this just a short-term fake out that wipes out all the stops that was just like a puke, and then does it snap back like a loon dive, or is this now just to open the floodgate and the lows of 2016 are the target? It's going to be something to watch.
I agree. It's something to watch. I won't ask you what you think because I don't want to Goocher it.
Number two, ECB. So like, what's going on? The euro, by the way, what a swing. Like, again, you're looking like a rock star. We were talking about, I was offering you a bid to close out that steak dinner bet that we had on the thing, and you're like, no way. I'm not closing out the bet.
You know what's funny? Our good friend Cuppy. I also told him that I was offering him a bid, and he said no way that he's closing either. You guys are firm, and it looks good for you. So if those who don't know, Patrick sold us one touch call options on the euro going to what, 115?
115, yeah.
And steak dinner in Miami. I've never been to Miami. I'm looking forward to it. But one of the things that I kind of laugh about Cuppy that I love about him, he's getting hammered in the markets. Like, we all have points when the markets don't agree with our views, as I know too well. And he's getting hammered. He kind of texts me or DMs me, and he says, listen, I'm getting completely shellacked on my tankers. At least I'm going to win that fucking steak for Patrick. And so I kind of laugh. I thought that was so funny. It was so Cuppy, right? Like, I just made me laugh so hard, and good for him. What is how far are we all away from that?
We're around 113. Unbelievable.
So
swing.
Wait, what's our one touch?
115. It's within a stone's throw.
Holy
200
shit.
pips.
Yeah. Listen, U.S. dollar, for all the U.S. dollar milkshake bulls out there,
like me.
Anyway. It's going the other way. You guys are high.
Oh my God. Okay.
Yeah.
You know what?
But anyways, listen. What we're supposed to do.
At least we're not goochering it for anyone.
Listen, we're supposed to do top three things to watch next week. So what are we talking about? We're talking about the ECB,
which is where that's why I was mentioning the euro. But
although I think it's important, I am worried if they cut rates, and I'm not, because like, you're cutting negative rates. Like, it's gonna make things worse. Don't cut rates. Do fiscal. So I do think they'll do a little token something or other. I hope they do so little that it doesn't matter, because the truth of the matter is that they've long lost the ability to go and stimulate anything through monetary policy.
Yeah,
and they're making shit worse. And I'm really hopeful that Lagarde's figured this out. It'll be interesting to see. This is the first time she's had a chance to actually do anything.
Yeah.
So here we go. We find out if this kind of negative rate kind of orthodoxy is going to continue or not. I'm betting it doesn't.
There you go. You heard it right from Kevin. So number one, and I mean, this has to be on everyone's mind, right? As soon as the rate cut occurred, 50 basis points, the market pops and then gets sold right away. We went and retested those lows. We were right back down to 2,900 on the S&P. And it just feels like the market can't catch the bid, and it just looks like it's going to puke on the downside. And the thing is that we're so oversold on this market that it's like, look, if we're in a bear market, what a lot of people believe is that a bear market is just straight down, but there are violent mean reverting rallies that occur.
The largest rallies occur in bear markets.
In bear markets. And so the thing is that what in both the 2000 and 2008 bear markets, each of the first sell-offs was anywhere from 12 to 16%, very similar magnitude of what we had here, or was it closer to 20 on the one of them? And anyway, point is that within a few percentage points of where we were. And then came a multi-month rally, and we heard from Jason earlier that that when you have this kind of extreme sentiment, that these things happen. And one thing that I think is worth watching next week is, do we have a capitulation low? Do we wake up Monday 200 points down? It just everyone's like we're at 2,700, everything going to hell in a handbasket, hits a low, and then it's just up from there for a month or two.
So here's something I'll say to you. That's what everyone's expecting. That's what everyone's waiting for. I feel like this is the market that just doesn't give people what they want. And it's not that easy. So it wouldn't surprise me at all if all of a sudden the buyers just come back and you don't get your capitulation, and then it just frustrates everybody.
Yeah.
You know what? I just I throw that out there. And I
don't agree with you.
Yeah, you think we're gonna need the capitulation low?
Well,
I get it. I understand the theory.
My squiggles still suggest that there's room.
Hey,
to
by
go.
the way, did you see that article I sent you from Bloomberg about how in this environment Fibonacci's are actually hitting the out of the park?
Yeah, they are good.
Like all these
all the
levels?
fibs, all the fibs levels are turning.
All the fib levels. It's like
it's
almost like it works.
It almost like it works. Nonetheless, let's watch whether a swing low comes in next week. I think it's going to be something to watch. I still think the market has room to go lower. I'm glad you don't agree, because we'd fucking Gucci for everybody.
Yeah.
All right. And so there you heard it. There's
what I'm saying is, I'm saying that I don't think the low is going to be this dramatic climactic affair. I think it could surprise everyone. I think we might have already seen it. I don't know for sure. I just think that there's a potential. If we got massive fiscal this weekend, we would wake up. I could see the S&P gapping up 100 points and just running. Listen, I don't know if that's coming or not. I'm just saying, you know me, I'm not a believer in the dark magic as much as you. I don't think we need that capitulation low. I think the market could surprise everyone and frustrate everyone. That's what it seems like it does the most. So I don't think we need the blow off kind of low. That's all I'm saying. I'm fading that you need that to make the low.
All right. So you heard it. You heard it here. I'm not going to say anything else. So let's move on to the parting words of wisdom. Look, this was it's such a famous one, but it's like, don't double up on your losing position. You shared with us a story at 2009 that actually worked. You were bragging about doubling down.
No, I didn't double down because I bought irresponsible amount. So at the first round, and then I just bought a little bit more. No, I was wrong, and realistically, I should have bought half and expected it to go the other way. You should always assume the trade's not going to work in your favor, so that it, when it doesn't, you can deal with it. No, I treated that terribly. I was lucky. Yeah. I almost got shaken out, Patrick. The whole goal is to make yourself invincible to having to get shaken off. And if you're sitting there and you can't sleep and you're worried about it, or you're getting to a point where you think you're going to puke,
you size the trade wrong.
Yeah. So that's, and I contend that all the time.
But what almost always kills retail investors, is it is so emotionally difficult to cut a loss, and if you. And
Patrick,
when it starts losing,
no,
but you add to the position, but now you're throwing good money after bad, And what happens is that that money is now trapped in your psychological
Completely agree.
mode.
Yeah.
And the people that have suffered the greatest losses are ones that get stuck in that spiral.
Yeah. Why do you think George Soros would go on a Friday night and phone up Goldman Sachs and say, here's my whole inventory, flatten everything, starts over? All the best traders do that. They don't let themselves get stuck in that kind of mentality because it ends up taking mental capital, which is more important than monetary capital. The other thing, you have this don't double up on a losing position. I always think back to Paul Tudor Jones with that famous video during the 1987 crash. And on his wall, it says losers average losers, meaning that losers, average down.
Yeah.
So remember that. Great parting words of wisdom, Patrick.
It worked out for you, though.
No, on that one trade. Listen, there's so many other ones that I wish I had just driven on.
Yeah.
And, and I'm on that trade. I'm not trying to say that I did everything great. I would probably traded it poorly.
There you go. All right. So listen, some closing remarks. Please take the opportunity. Well, first of all, follow us on Twitter at the Market Huddle.
Yep.
Right. And as well, if you enjoying the show, you can go on to iTunes and give us a like. Just help us build the brand of the show.
I don't think on iTunes you give likes. I think you do reviews.
So
we'd really appreciate a review on iTunes because it helps more people discover the show and makes us so we can get more kind of great guests that we enjoy having. And I think Lena's always bugging me to say something about YouTube. I think in YouTube you're supposed to like something. Aren't you, Lena?
Hop on here, Lena. What are we supposed to tell them?
Thumbs up and subscribe.
What is it?
Subscribe.
Thumbs up and subscribe.
Thumbs up and subscribe. That's what the millennials do.
Because Lena's bonus depends on it. No.
That's right.
There you guys go. So don't do it for us. Do it for Lena.
Yeah, for Lena.
That's right. Everyone, give us a review. Give us and make sure you give Lena, when you're doing the review, say the show wouldn't be the same without Lena. And this is Lena's why we're doing it. Those two other assholes, they I don't know. We should get rid of them anyways. Anyways, so we're on Apple, iTunes, podcasts, Spotify, everything. Just kind of YouTube as well. Make sure you go listen. We really appreciate your time. We know that there's a lot of different options. We have fun, and it wouldn't be the same without you. We really appreciate it. I'm Kevin Muir. You can catch me at the macrotourist. At kevinmuir.com. And Patrick
Ceresna. You can find me at Patrick Ceresna and at bigpicturetrading.com.
Oh, yeah. Wait, one last thing. We're supposed to do this. Big thanks to Rob Koyfman at Koyfman Financial. We really appreciate his sponsorship of the show, and we love his product. And that's it. Have a great weekend, everybody.
All right. Thank you very much, everyone.
So
Lena, hop on.
We kind of we stumbled a little, there at the end.
Yeah, we suffer.
That's okay. It's nothing new. Let's talk about beers.
Oh, yeah, that's right. So, you know what I've decided? I like pale ales.
You do, eh?
Yeah, like if it says pale ale, I'm pretty well in there. I don't even know what that means.
It's a nice 5.6%. You don't have those like 7-8%.
I don't even know what it means, but I like it. I don't really care. Like it's like I'm like the idiot that goes to the art gallery and just goes, I like that one. I don't care. That's me. That's how I feel about beer. I don't know anything about it. I just know what I like and I don't like. Pale ales.
You know what? Thank goodness, because Big Spruce Brewing was kind enough to sponsor us with 4 beers, and
we got 2 more to go.
And you shat on their first.
We
beer.
started with the bad one. We did shat on it because it was shattable. Like it really was bad. Like it was just. There's never been an oatmeal stout that I've liked. Like just think about the oatmeal stout. Like what the hell? You have to.
I thought you were maybe disagreeing with Patrick just for the hell of disagreeing.
No, it was bad. It's like, listen, the only guys that drink oatmeal stout are like beards, wear lumberjack jackets, and like vape.
Well, I mean, it is Big Spruce Brewing, and it's organic beer. That to me is hipster central.
It is, but I like this one. I'm a big fan.
Yeah, this is a good one.
Yeah, and listen, they're from the East Coast. I love the East Coast people. They're just they're
down to earth.
They're so nice out there.
They are. It's just kind of they're great. East, West, basically. I just don't like Central.
In the prairies where there's nothing.
Come on, the prairies are awesome.
You just said you don't like Central.
No, Central is Ontario.
Oh, whoa.
Listen, Winnipeggers, we
Wait a
consider ourselves
wait a
Westerners.
minute.
We don't consider
What?
ourselves Central.
If you were to divide Canada into half, Winnipeg would end up on
The dead center.
East side.
If you divided Canada in half, it would literally go between Manitoba and Ontario.
Really?
Come
Is
on,
that how
do you
it is?
disagree?
Apparently, I need to brush up on geography.
Like, do you disagree?
I'm just not going to say anything else.
Why? You always whip out in these after hours.
Because he's afraid
I
he's
know.
going to say something.
I'm a little
gonna-
bit drunk, and
him
I
out.
haven't looked at a map.
Anyways,
I never bothered to grab a ruler and actually start measuring.
Hey, so have you been to all the provinces?
no,
Which province haven't you been to?
I actually have not gone to like Newfoundland.
Yeah, either have I.
No,
They're
I haven't
wonderful
been- I haven't
people.
been to the
Wonderful people if
territories.
you can understand them.
I've
Like,
not,
no, really. Like, and if they're drinking, they're like Irishmen. Like, they're tough. Literally, I love the Irish. Irish are my favorite people. Like, if you said to me, like, you could only live with like the rest of your life with one people, Irish, without a doubt.
the peoples.
Really?
Oh, have you ever been, Lena?
No, I haven't been to Ireland.
They are the
no.
most wonderful, kind, warm, giving people I've ever met in my life. I love them. Like I can't tell you how much I love them.
Right.
Now listen, it rains
Really?
all the fucking time there, so I don't know if I could handle that. But I love the people. They're just
How
awesome.
can they be so nice when it's raining all
I
the
don't know.
time
They're
there?
just, and even like I remember I went there and they were like, okay, so here I'll tell you a story. I went there. We went to Dublin, obviously. We had a good time. It's like a relatively big city. It's not really that big, but it's relatively big. Then we take a train across to Galway. So where Galway is like a town on the ocean, and it's kind of a tourist town. We get there, and from the train station, we have to go to get my car. And my car is like at some spot. So it's like a 20-minute car ride. So I get a cab to go get our car rented. Along the way, the guy starts talking to me, and he starts asking me about us, and he's like chatting. And I'm like, and he says to me, have you ever driven on the other side of the road? I said, no. He says, oh. And he starts talking to me, and he starts telling me all this advice and stuff like that. And we get there, and he takes time out. Like, I've already paid the guy. He's taking time out to, like, draw me maps because he's worried that I'm going to have trouble with the roads. And I'm like, dude, I'm not.
What year was this that you
Oh,
were
like
gonna have trouble with the
2013.
road?
Oh no, it's like
Oh.
like the roads are hard and they're small and they're like on the wrong side. And like, have you ever driven on the other side?
No.
It's hard,
Well,
actually.
I can't even.
It's actually-
I can't even imagine.
It's harder
driving on
than
the
you
other
think.
side
You
of the
get a
road.
hold of it, but I always think, like, I repeat to myself, I come up with a mantra, like, left. Like, I try to, like, force myself.
Yeah, stay on the
Yeah,
left.
because it's hard. Like, I don't know how guys that, like, the Top Gear guys, like, they go and they switch all the time. I don't know how, like,
Yeah, it's crazy.
it's hard. It's like,
Yeah.
like I get a hold of it, and you know what freaked me out the most was actually getting onto on ramps on a highway, because all
my
I can
God.
imagine to myself is like I'm getting on the wrong on ramp. I'm about to like go head into
You're gonna
traffic,
merge
right?
into the wrong side.
Like at night, and you're just like, this is the wrong side. I'm like, and it just freaks me out. Anyways, back to the Irish. They literally, this guy sat there, and he took like 20 minutes out to like draw me maps and stuff, and I'm like, dude, you got to go earn a living. Go away. Like, he's just so giving, and he's worried about it. He was legitimately worried about me. And I just, anyways,
Oh, it's so
they're
nice.
they're the nicest people, and they're funny, and they're self-deprecating, and they're just awesome. And I love the Irish.
There you
And, like,
go.
that's like, I'm not Irish. I'm actually Scottish, but I just love the Irish. And we went to this place, which is Ashford Castle. And this was way back when, and it's actually an old Guinness estate. And we always say, my wife and I always say, we would want our kids to get married there because we had the greatest time in our, like, it was just one of the most wonderful vacations that we've ever had, spending time there. Now we can't afford it because they've been bought by some fancy company, and it's now one of the most expensive hotels in the world. So we can't afford to actually have our kids married there, but if we could, we would love it.
They can take pictures in front
That's
of it.
right. Anyways. Okay, let's talk beer. Sorry, I kind of got sidetracked there.
Lena.
Lena, what do you think?
I'm giving this a solid 9.2.
What?
Holy,
And
that's
you
good.
went into
Yeah,
the
I really
nines.
like this one.
That's nice. I'm gonna.
I finished this in no time.
I'm giving it a 9. Not even. I know that's a rookie score,
right.
but I'm
going to let you guys own it. I'm going to give it an 8.8. It's a great beer, but I just don't want to take your thunder. You guys can own it.
Okay. Listen, pale ales.
Not a competition.
Well, it's going to be interesting to see how we do on the rest of the Big Spruce. Yeah, it'll be interesting to see.
This was a good one. I really like this one.
Yeah, no, this is, well, Lena.
Definitely sessionable.
Oh, God, we had to do the sessionable.
I'm going to stop saying that.
Yes.
You should. It's kind of embarrassing. It's like, it's like
Kevin,
an old guy saying
I finished watching The Succession.
Okay, so what do you think?
Oh my God, that season finale of season 2.
I know, it's awesome.
Holy shit.
It's so good. Season 2 is awesome. It just like kept getting better and better
it
and
was
better.
So good.
Yeah. So for those who don't know, and Patrick's never going to watch it. He's still working on Friends.
More like Golden Girls or
Golden
MASH
Girls.
Or something.
He really likes one of them.
I'm on season 2.
Do you know what? Okay, listen, I got something to tell you about Golden Girls. One of the women, like for those who don't know, the millennials that are listening, Golden Girls was this kind of situational comedy with, 4 or 5 older women whose husbands passed away and they all lived together. And they seemed so old at the time, and that was because I was young. But Lena, guess how old one of the younger woman was when she played, when she started Golden Girls?
Oh, I don't know, like in her 60s?
Yeah, so that's what I would say too, right? I go oh, okay, maybe she's a little young. Maybe she's 65. Nope, there was a 53-year-old when they started it. I haven't got a 5 handle yet, but I'm not that far off. So it's it's kind of funny that basically I'm becoming Golden Girls age. They're looking kind of hot.
Yeah. I mean, Betty White's 98 this year, right?
What?
Or was it last year? Yeah, she's almost pushing 100.
So she's awesome, Betty White, because she laughs and stuff.
She's amazing.
She really is funny, and she's willing to laugh at herself. So it's really kind of funny.
That's
okay,
awesome.
Yeah.
So Succession, you loved it. It's great. Everyone watch it. It's really terrific. It's amazing how there is not a single likable character in it. It's kind of like a Market Huddle episode. No, that's not true because Lena hops on. It's kind of like Market Huddle without Lena.
Yes, that's exactly what it's like.
No, but it's so funny because you want to like somebody and they're just such dicks.
Yeah, it's I think I might like this person. Oh, this person's got a redeeming quality. And then 2 minutes later, you're like,
yeah.
No.
And even the woman there, the daughter, I'm I kind of like her.
Oh my gosh, she's the worst.
And then she just ends up being, you're just so bad. And then the guy with the coke and drug problem, you're I might like you. You're really not that bad. Then you're no, you're just you're a horrible human being. They're just all terrible.
That's
just awesome, awesomely terrible. It's kind of great. I'm looking forward to season 3.
Oh, there you go.
I'm
you heard
totally
it.
waiting for it.
Okay.
Patrick, you have homework. You got to watch it.
Yeah,
yeah.
Patrick, you got to watch it. You know what? Patrick will watch it in 5 years. He's the worst.
Oh my God.
Do you watch anything, Patrick?
No, I haven't been watching anything recently.
God, what do you do?
It was weird.
You just big picture.
I just produce content. I don't watch TV.
You are TV.
I am TV.
You are TV. I don't. Why would I watch it when I can be it?
Yeah, there you go. That's exactly what I was
That's
thinking.
what you think.
Yeah, he's on a completely different level.
That's right. Why would I watch that? I could be in that box.
There you go.
I can be.
All right.
Okay.
All right. Listen, have a great weekend, everyone.
Yeah, for sure. Thanks for everything.
Yeah.
Lena, good luck with editing this bad boy.
Thank you.
All right.
Take care, everyone.
All right. Take care, everyone. Cheers.